Hello, everybody. So today, quickly, I want to talk about overconfidence on Wall Street for retail investors. That's a huge problem. Overconfidence is all around. You see it on the activity trading, and there are too many changes. And if you look at it, it makes no sense. Retail investors don't make a lot of money on the stock exchange. Even the stock market goes up average 10% a year. So I give you quickly an overview. Just look at the stars on the stock market. Look at Carl Icahn, Warren Buffett, George Soros, and Bill Ackman and David Einhorn. They are not so active in their trading habits. They buy and hold for a while at least. Well, one of the most patient investors is, of course, Warren Buffett. He holds for decades, usually his investments, especially his core investments. So, quickly, what goes on in the head of the private investor? He thinks he can outsmart, he can be smarter than the market, than the other people out there, but it's a fight against machines, about genius people, about professional traders. You can usually not win this game. It's like going in a casino. Usually the bank wins in the casino, and but the private investor doesn't understand it and doesn't get it, because the problem is it's like you're going to playing golf. You're like play a little bit golf here and there, and you are calling up Tiger Woods and say, "Oh, let's do a match." You will lose that quickly. Same, you go out there and you want to play chess against Kasparov, the former world chess master, and so you cannot win it. But that's people assume that on the stock market, they think they're gonna win that game, and it's just silly. I don't understand it. So how to avoid it? Just don't trade too much. Buy and hold. That's one advice I would give to you. Just be more patient. The other thing is go against the current, go against the mainstream. The masses are running in one direction, and usually people follow them. These are trends. These are like streams, and they are usually overpriced. If people like social media, if they like electric cars and solar power and all that stuff, Warren Buffett invests in old-fashioned things, like he bought ExxonMobil. There's a lot of cash. There are a lot of earnings. It's a rock solid company. Of course, ExxonMobil has problems. Of course, IBM have problems, but they are around for more than 100 years. They are still doing very well, but they have problems, of course, but the cash flow statement is still rich, and so on. Or look at David Einhorn. You saw that he bought in British Petroleum. The company's under pressure after they had the accident a couple of years ago in the Gulf of Mexico. So what you see is there are problems, but the valuation of these old oil companies are very low, based on enterprise value, the multiple with EBITDA, with the cash flows, based on the PE ratio, on the book ratio, and price to book. So those people, they go against the current, the professionals, and they buy and keep. They are invested longer. Like even Carl Icahn, they call him a raider, a trader. But he invests usually for many years. He buys Apple. Apple is a long-term, a great stock. It goes up average more than 20% for decades, for many decades. So it's not that trendy thing. Of course, it's a consumer electronic company, but it's doing very well, even over a long span of time. So what you can learn from it: be very smart. Consider that you cannot go out there and trade like against all these professionals, and against the machines and computers, the high frequency traders. They will be always better than you. Some people at Goldman and JP Morgan and so on. So consider this when you go out there and trade. Yeah, you can make a buck here and there, but overall, those people, they are like sharks. They are better informed than you. These are the Tiger Woods and the world master, the world players in chess. So think about it. Then also, the private investor has a lot of advantages. They have nobody who tells them what to do. They have all the patience of the world if they want. They have so many advantages against all these professionals. So use those advantages, and nobody tells you what to do. You can go against the stream. You can do your own thing, and I mean you also, one big problem is you don't have to talk to managers, to CEOs, to CFOs. As a private investor, you can. That's a problem of a lot of fund managers. The CEO and CFO, they're in their company. They have to tell you a story, and usually that story is nicer than the reality is. And people get sometimes kind of brainwashed with, if you have to listen to them, you see them at the presentations, they visit you in your office. If you're a fund manager and you have this influence of all these people around you, they tell you how great their company is, and so on. As a private investor, you can avoid it. You don't meet these people, and that's a good thing sometimes, because you see more the facts and the reality, and not the dreams of these CEOs and CFOs and so on, and investor relations managers. So I would suggest focus on the facts, that don't dream, stay focused, be patient, and you will do very well if you avoid what most people do. They buy what is already up. They buy high and sell low.